Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon, and thank you for making time today.
Good afternoon, Devin.
Well, Professor, stocks on Wall Street actually started the session higher on Tuesday, but with bond yields rising, stocks quickly turned negative. Only a moderate gain for tech shares on the Nasdaq, 0.25%. What's the story in the global markets?
From the Fed's giant step last week, and it's expected more aggressive interest rate hikes until the end of this year, U.S. equity market lost the steam of momentum. The Dow Industrial and S&P 500 fell again Tuesday as investors parsed a spate of economic data and comments from Federal Reserve officials. The Dow Jones Industrial Average, which entered a bear market on Monday, fell 0.4%. That marked its sixth consecutive day in the red. The broad S&P 500 slipped 0.2%, closing at its lowest level of the year for the second day in a row. The S&P 500 is also now down for 6 days in a row, its longest losing streak since February 2020. The tech-heavy Nasdaq rose 0.2%. All Asian markets slipped today, too. Japan's Nikkei 225 dropped 1.5%. Shanghai index also retreated 1.6%. Hong Kong's Hang Seng lost 3% today as of 3 p.m. in Seoul time.
Well, a big story today, the Nordstream pipelines carrying gas from Russia to Germany are now leaking, reportedly following explosions. Officials in multiple countries suspect sabotage, but that and other concerns sent Korean stocks plunging by 2.5% to 3.5%. Tell us about the domestic equity market.
As interest rate hikes continued and economic recession is more expected, domestic markets decline prolong a brutal year for financial markets. Also, the accidents on Nordstream gas pipeline, which is the geopolitical issue, added as another risk to domestic markets. Stocks and bonds have both dropped sharply this year, which is an unusual combination that reflects just how unnerved many investors feel. The KOSPI and Nasdaq are all on the pace for their worst first 9 months of the year since 2009. The benchmark KOSPI retreated 2.5%, and Nasdaq further slid 3.5% today. In KOSPI market, foreign investors and domestic institutional investors together nestled stocks up to 473 billion won, which is larger than the average net daily sales. Most of top 20 large cap stocks dropped today. Samsung Electronics dropped 2.4%. LG Energy Solution also lost 2.4% today. But Samsung Biologics and Celltrion both rose today.
Well, now, oil prices have come down a lot lately, but we're seeing a tick back up now, in part because of the hurricane that's now in the Gulf of Mexico, which will block off more than 10% of production in the region. What do you see happening with oil prices, Professor?
Oil rose today from a 9-month low a day earlier, supported by supply curves in the U.S. Gulf of Mexico ahead of Hurricane Ian and a slight softening in the U.S. dollar. In addition, markets expect that the OPEC Plus may take action to stem the drop in prices by cutting supply, which is a support on international oil price. OPEC Plus missed to set new policy on October 5th. Brent crude oil ended the day at $86.27 per barrel for a gain of 2.6%. On Monday, it fell as low as $83 per barrel level, which is the lowest since January. U.S. West Texas Intermediate crude ended the day 2.3% higher at $78.50 per barrel. Crude sold in early 2022, with Brent coming close to its all-time high of over $140 per barrel in March after Russia invaded Ukraine, adding to supply concerns. Worries about recession, high interest rate, and dollar strength have since added on international oil market. The price drop has raised a speculation that OPEC Plus could intervene in the near future. For example, Iraq oil minister on Monday said that the group was monitoring prices and didn't want a sharp increase or a collapse.
Right, it has been a wild ride for oil prices lately. Well, finally, Professor, we're hearing talk in some corners now of a repeat of the Asian financial crisis of the late 1990s, with the currencies of China, Japan, and Korea now at their weakest against the dollar since roughly 2008, 2009. It's widely believed that the most vulnerable of these three is the Korean won, a serious concern now for these countries. Where do you see these currencies heading?
Asian markets risk a reprise of crisis-level stress as two of the region's most important currencies crumble under the onslaught of the relentless dollar strength. The yuan and yen are both tumbling due to the growing disparity between the hawkish Federal Reserve and dovish China and Japan. While other Asian nations are digging deep into foreign exchange reserve to mitigate the dollar's damage on domestic economy, the yuan and yen's slump is making things worse for every Asian country. The tumble in currencies of the region's two largest economies may swell into a full-fledged crisis if it spooks overseas funds into pulling money out of the Asia as a whole, which leads to massive capital flight from Asia. Actually, global funds have taken about $44 billion out of Taiwan's equity market, $20 billion from India's equity market, and lastly, $14 billion Korean equity market from the beginning of this year. And according to an analyst in Hong Kong-based asset management company, the most vulnerable currencies could be those with the deficit current account positions, such as Korean won, Philippine peso, and to a lesser extent, Thai baht.
Right, it's a concerning situation. Hard to see an end to it, really. Professor Kim Sei-wan, we'll have to wrap it up there for today. Thank you, as always, for coming on. Really appreciate your insights.
Thank you very much, Devin.